Hi, everyone. As always, feel free to go ahead and ask questions, and I'll review it in at the end of this. Just checking one more thing. All right. So overall, a fun, typical day of a lot of sideways trading. So if you found yourself buying and the market immediately reversing down, or selling and the market immediately reversing in the opposite direction, I would challenge you to think about doing the opposite. So, in other words, you see a sell off and then this really deep rally, but then you see this deep rally and a very deep sell off. And then you get a lot of bars down. It looks like it's going to break below 12, but then all of a sudden it just reverses up. And then you get this strong rally to the open of the day right here, and you just melt to the downside. Then you look at this rally at 86 and you think, 5 bar micro channel, buyers below. That's easy. I'll buy the low and I'll put a stop below 65. And then I'll just scale in. And then all of a sudden, darn, I get stopped out, only to watch the market go right back to where you were. And the reason is it's a trading range day. And obvious places for your stop are obvious places that the market's going to go. So think about it like this. There's 2 ways you trade a breakout. A breakout is any bar when the market goes above or below any bar. And let's just take the whole sell off from bar 1 to 12 for a minute. And when we look at this sell off, first off, or bar 2 to 12, it's a big sell off. 2 things are likely. If you've watched Al long enough, if you've studied the course long enough, you already know what I'm going to say. Big enough sell off, either the day is going to be a trading range day or the day is going to be a bear trend day. Trading range day could go all the way up here before it goes sideways. It could certainly go above obvious stops. So if you're short at the high of 12, look what happened if you put your stop 1 tick above 12. Price went up to here, triggered the stop, and immediately turned down. Even if you had a stop up here. I mean, imagine selling the 12 close, putting a stop above 6. We've all done it. You get stopped out on 20, only to watch the market go right back down to the 12 close. And the reason is it's a trading range. Traders look at it like this. They see this. They look at, let's say, a 15-minute chart. And let me just make this a only chart. Like so. And they see a big bear bar and then a doji and then another big bear bar. They see 2 legs down, but they say the sell off is big enough that there's probably sellers at 50% or above any high. And because of that, traders sell. They see this big rally and they say, yeah, it's either a bull leg in a bull trend or a bull leg in a trading range. So if I buy here and at least buy more at the low, look what happens on this pop up. Traders get out break even. And that just takes a really, really long time, I think, to get really just comfortable with that mentality. I get it. And these days can be frustrating. That's why a lot of traders trade really small and they scale in and scale out of trades. So let's start with the weekly chart. So the weekly chart, we had this triangle. I'm going to go ahead and remove it for now. I think it's a little bit distracting. And what do you notice about the weekly chart? We have a lot of overlapping bars. So we get this big bear bar, and this is a good example, the March the 10th. So we get this big sell off on March the 10th, and then an immediate reversal up above March the 10th. But let's look here. If you sold the close on March the 10th and you sold more at the high here, look where your break even is. No surprise, break even is at 4,000. So when you look at the weekly chart and you think to yourself, are we, what do you think is going to happen? Look at the green line. It's in the middle of this. It's a triangle to here. If you want to draw it like that, doesn't really matter. We go up for 3 bars and then we immediately get a deep pullback. Yeah, the weekly chart looks a lot like today. That's exactly right. And that is because today looks a lot like a trading range day. Traders buy too high in the range. A lot of them are really quick to get out. And why are they? Remember, I think one of the single most important things you have to learn is to really believe that markets are fractal. Price action is price action. It doesn't matter what time frame. The only real thing that matters regarding a time frame is one, can you bear the risk tolerance required for that time frame? So if you're trading the E-mini and you're trading a weekly chart, obviously you're risking several hundred points and most traders cannot do that. But also, if you're trading a smaller time frame, can you make quick enough decisions? So let's talk for a minute about the weekly chart. We rallied up to here. And if you're a bull and you bought this close and you're thinking, yeah, first reversal down is probably going to fail. I know it might be a second leg trap, leg one, pullback, leg two, but I'm going to buy this close. And if you think about stop placement, you've got a couple of choices. One is the easy. You put your stop down here or here. But it's really a flawed stop placement. It doesn't make a lot of sense. So why does it not make a lot of sense? Well, if the market falls down here below June the 17th of 2022, what do we think is going to happen? We know there were buyers down here. So if you're buying here, the last thing you want to do is sell out of longs down here. Obviously, the better thing to do is to buy down here. That's why a lot of traders, you always hear Al say, in general, when you're in a trading range, a lot of traders will exit after 2 or 3 bear bars, closing on their rules. You know, some people, I guess you can call it the 3 bar rule. And kind of like here, tight bear channel, but then we broke below the moving average. Big enough bar, strong enough sell off, probably a second leg down. So traders will start to exit on any reversal because their worry is where's the bottom? They don't want to be long and have a stop here because there might be buyers at this low. And look what happened. Imagine buying up here and selling out of longs here. You basically get out at the worst possible place. If anything, you should just bought more and you could have gotten out break even. And that's what happened. And that's the same thing with over here. So when traders see 2 or 3 bars down, they exit on any reversal up. And look what happened down here. The market goes a little bit below, but then immediately reverses back up. Didn't quite get back up here, but I think it did later on. Well, it hadn't yet, obviously. But either way, if you bought here, scaled in, you got out break even. Now, why am I spending so much time talking about that when this is supposed to be discussing the 5 minute? And the reason for that is it's trading range mentality. We have a strong rally, but look to the left. So let me see if I can do this. There we go. So what do you notice? This box drawn to the left. If you're buying the close of bar 47, what do we notice to the left? We're at the high of the day. So if you're buying up here, where's your stop? Is it below 46? That's not ideal because if it's a trend, sure, you could argue buying, putting a stop here or even below the bar, because the reality is if this is going to lead to a strong upside breakout, the market shouldn't stall. But if you put a stop all the way down here, that is really it's not really a logical stop. It's really you can call it an internet stop or you pass out at your computer kind of stop. You cannot let that get hit. So a lot of traders, if you look at people like Al, if he's trading, a lot of traders just have stops in the market somewhere and they have their finger, they know where they're going to exit. And as soon as it doesn't do what they want, they exit. Most traders can't do that. And the point with that is when you start to get disappointed in here, you have to ask yourself, if my stop is at the 40 low, can I really afford? I cannot afford to get hit because this is where traders are going to buy. So if anything, if I'm buying up here and I think we might fall below here, but if we do, we'll probably reverse up. What's the smarter trade? The smarter trade is to buy and buy more lower, but you have to trade really small. The other alternative is you have to be very quick to exit and you have to get out on a second entry because now the probability of going somewhere down here is much closer to 50-50. And that's confusing. I totally get it. But it's reality. And with trading ranges, people end up, the reason why people screw up and when they're trading ranges is because of this spreadsheet right here. And I really want to talk about this first. I'm still going to review the day, but I really want to bring this up because traders have the right idea. They're going to go for 1 times their risk, and their thought is, I'm going to buy the close of a bar. I'm going to risk, $100, make $100, and I'm going to risk 1 point. They're going to risk 1-to-1 risk reward, and they're going to be 60% profitable, and that works. It works really well in a trend day. The problem is, in a trading range, it can work very poorly because your risk reward, let's say it is 60. So you have a great risk. Your risk reward is 1, probability 60. So remember this screenshot right here. In a trading range, here's what's happening. You go from 60% or maybe even 70%. This works out really well. But then you get 1 bar against you. You get bad follow through. Now it goes to here. And a couple of minutes later, it goes to 55. Then it goes to 50. And then all of a sudden, everybody realizes that the trader's equation doesn't work. In other words, a 1-to-1 risk reward is going to fail. Everybody bails out of the trade. So let's look at an example real quick. Because if you don't really understand this concept, you're just going to get clobbered in a trading range day. And this is a great example. Bar 20, it's a really big bull bar. And you can make the art. It's not a great buy. It's 3 pushes up, 14, 16, and 20. So it's basically a wedge. And it's high in the range. This is where traders got trapped. But let's say a trader bought the close of 20. And they said, I'm going to buy the close. It's a big enough bar. We should go a little bit higher. So remember what I said. They have a 1-to-1 risk reward. Stop is at the 20 low. Their target. They buy the close. Their target's up here. So here's their stop down here. Here's their target, or here's their entry price. And their target is basically 4,100. Now, if that's the case, already with the tail, it's probably not 60%, but let's just pretend that for a minute it is. If this trade's going to work, it needs to work really quick because time is against this trade. It's buying high in a trading range. And it's the same thing as 12 selling down here. But if you buy here and then you get that for follow through, that is a sign of hesitation. That means that there was more traders selling in this area than buying. And because of that, you will have traders start to bail out, which is what happens here. So 60% chance it's going higher. And then all of a sudden, just with one bar, even though it's a bull bar, the probability diminishes to a losing trade. And right on the open, look what happened. It sells off. Here's a better example. Traders sell the close of 12, stop up here. Or better yet, let's just pick a place. They're selling and they're putting their stop above the high of 11. And here's their target. So far, looks good. Good bear bar. 60% chance we're going lower. And I'm ignoring price action. It's really not ideal. It's not 60%, but let's pretend it is just for the sake of argument because it works. So 60% chance we're going lower. But then what happens here? Well, a lot of traders on the close of this bar and the open of this bar, the open of 13, which means 13 doesn't look like this. 13 is a small doji. Let's just say it's a couple seconds into the bar. What happens is the market is stalling. So if I'm a bear and I sold the 12 close and I'm thinking to myself, this is a really dangerous trade. It's 2 legs down. It's 3 pushes down, 10, 11, 12. It's a possible sell climax. It's possible exhaustion. If this is going to work, this needs to just crash really quick. Minute 1 goes by of bar 13. We're still sideways. Minute 2, then minute 3. And what happens? All the bears that sold down here start to give up on the idea that it's going to work and they start bailing out of the trade. You have other bears on the close of 13. They say, yeah, it was 60%, but now with the close of 13, there's no way my trade is 60% that we're going down here before we go up here. At best, it's 50-50. So if it's at best 50-50, I have to exit the trade. And that's why traders exit on a stop above here. Look what happened at the 14 low. Some bears, they sell, they scale in, desperately trying to get out at the low close, and they don't get filled. So in a strong trend, you can almost sell anywhere and scale in and make money. Sell the close, sell this close, scale in, make money. Let's go to here. This is a great example. You can just sell with any bar and scale in anywhere and get out at the low close. You can sell here. And this is 19 bear bars in a row. You could sell this close. You could still get out with a profit. You could sell this close and scale in and still get out on 27. Trading range days, the probability is much closer to neutrality. It's neutral for a lot of the time. And what happens is when everybody agrees that it's going to be a trading range and the breakout's going to fail, you quickly reverse. So that's why you get, just like right here. And I'll start the bar by bar here in just a few minutes, but I want to finish this. You get a strong rally and a surprise bar. Odds are you're going to go a little bit lower. But what everybody thinks is they look at this rally from 13 to 20 and they say, yeah, there's probably buyers in the middle somewhere. And you get a third bear bar, and then you get a fourth bear bar, and then a bull bar, and then a fifth bear bar. Very tight channel. And what everyone's wondering is this going to be one of those days that traps traders into buy that bought and scaled in lower, or are the bulls that buy and scale in going to make money? But trading range days, they always force you. They're very forgiving. You can buy the 26 high and buy more lower and make money, but they always go further than what traders want. And what they always do, another way to think about it is trading range days will inevitably, right when you think the bears need one more bar to make it always in short, it reverses. So you look at this and you say, yeah, this is good, but it's becoming parabolic and there might be more buyers at the 13 low. And then all of a sudden, 32 happens and the market fails to break below. If you go back to Al's books and Al's video course, what does he say? When you break below an extreme and the with trend traders, in other words, the bears who sold below 13, fail to make money, you can see we didn't even go. I don't think we even went enough for to make 1 point. So if you would have sold the low of 13, 63.25 would be your entry price. And you can see the market went 62.25. So it's a 4 tick trap. And no bull could have made money selling on a stop. And then the market just quickly reverses up. All right, so let's start going bar by bar. First bar of the day, we gap down and we have a bull bar. When you get a gap down, you know that the odds are you're going to get a second leg down. Gap, it's a breakout. Bar one is a bad follow through bar. Probably sellers above and at least a second leg down though. And you can see the mark went outside down. But bar one is a warning. It's a warning that we're probably going to have a trading range open. And also, if you include the context of the past few days, it makes a lot of sense to have a lot of trading range price action. Bar three, a big bear bar. So we're always in short, consecutive bear bars. Bar two, it's a good bar for the bears, but bar three, it's a little bit climactic. And because of that, that will increase the chances that there's the pullback could be deeper than what bears want. Give me just 2 seconds. Bar four, we have a doji, probably sellers above. What about buying below four or buying at the close, scaling in lower? You can, but the reality is it's not ideal because we could easily get a measured move way down here. Now, fairly climactic though. We've had a lot of selling yesterday. We're selling off on the open, so probably going to form a trading range. Bar five, deep pullback. Some traders bought the one low and they bought more lower, trying to get out break even. But to me, when you look at the five close and you compare it to bar two and three, ask yourself what's more likely? Are the bulls going to undo the damage caused by the bears on two and three, or are the bears going to get a second leg down? I suspect the bears are probably going to get a second leg down, but three is a big enough bar, or excuse me, five is a big enough bar. We're probably going to have at least a small second leg up. So traders will buy the close and buy more lower, betting on a second leg up. In six, it's a bear bar. Now, it's a bear bar closing on its low. It's a low one short. Because the bar closed on its low, it lowers the probability of the bulls getting a second leg up. But the reality is there might be more bulls buying the six low, at least for a scalp, before we get the second leg down. If you're a bull and you're long, do you hold below six? That's the problem. It's fairly dangerous because if you're a bear, if this is going to be a successful low one short and lead to a strong second leg down, we could easily trigger the six low and go straight down. So for the bears, it's actually not bad from a risk reward standpoint or probability to sell below six and put a stop above six. And you can see seven is a bad follow through bar. But look what happened at the high of seven compared to the close of bar five. Bulls by the close, disappointed six. They scaled in. Look at the breakout point. So the breakout point is 87.75. Excuse me, it's actually 78.75 for bar four, and the low of this bar is 79.25. So actually, this is actually interesting. For the bulls, if you're a bull and you bought above four, your entry price is 79 even. The low of this bar is 79.25. So right now, the break even stop for the bulls has not been hit. However, for the bears, they will probably keep their stop above the six high. and not get out above 7. So there may be more sellers at the 7 high than buyers. And you can see we triggered the buy above 7 and turned right back down. And then 8, another doji. So some bulls, if they bought above 7, if they bought the close of 5, they're disappointed with 8. They're even further disappointed with 9. And you can see we got our second leg down. Now 10 broke to the downside and went pretty far, but reversed up pretty quick. So what does that tell you? That tells me that traders, there were bulls buying the 8 low, buying the 9 low, buying below 4, buying below 5, all scaling in lower, and they're making money. Didn't quite get to the 9 low, but if you bought here and scaled in and the market went up to here, traders were able to at least break even or make a small profit. And the reality is, we're probably going back in this area. 10 and 11, it's consecutive bear bars, micro channel since 8, so 5-bar micro channel. Is it sell to close? It might be, but to me, I'm less interested in selling the close because this looks like 2 legs down in what's going to be a trading range day. It's possible we break a lot lower, but when you see a bar like 10, that's just a pretty big tail. So the market went down and found buyers. On 11, it went down and found buyers. So on 12, it's probably going to go down and find buyers. Now 12, it went straight down. So here is the argument. We have a breakout below 11. You can make the argument that 12 is going to lead to a measuring gap. And some traders, what they'll do, they'll sell the 12 close and they'll put a stop maybe 1 point above the breakout point, the 11 low, or they'll just put it 2 ticks above the 11 low, betting that if we close the breakout point, in other words, if 13 goes above the 11 low, then this will be exhaustion and increase the probability that we will test higher. And clearly, the gap closed. So now we have a wedge. It's a micro wedge, 10, 11, and then 13. It's a micro channel since 8, so that is a 6-bar micro channel. In general, 6-bar micro channels in trading ranges, 6-bar micro channels lead to second legs down, but this is a 6-bar micro channel in a trading range, and you know what that means. Trading range days lower the probability for everything. That's actually not really true. Trading range days lower the probability. They make high probability outcomes lower probability, and they make lower probability outcomes more frequent. So what does that mean from a probability standpoint? Trades that are usually 60% become a lot closer. They get closer to 55%. Trades that are 40% increase to 45%. Everything gets closer to the 50-50 neutral area. So when you have a 6-bar micro channel, it often can immediately reverse. That's why in trading range days, you have dojis that look weak and they still lead to strong trades. So for the bulls, it's probably an okay buy above 13, but 3 consecutive bear bars, 6-bar micro channel. There might be more sellers above 13 than buyers. Other traders wait for 2 or 3 strong consecutive bull bars. 14, low one short, but probably buyers below. 15, an inside bar. And then look, just like that, 15, bad stop entry, close below the midpoint, tight trading range. But on the very next bar, big rally. So why did that happen? Well, everybody is thinking 2 things. It's either a bear channel that's going to lead to lower prices, or it's trading range. If it's a trading range, all these bulls in here that bought and scaled in are going to make money. When everybody decides, so it's like right here, probability still barely favors, it still slightly favors the bears, and then game over for the bears, it's back to 50-50, and all the trend traders start to bail out of the trade. And then you get this, and all the bulls that bought here and scaled in made money. Now, 16 is a big bull bar. But you can see, why did 16, at one point, 16 was a bull bar closing up here. So why did it sell off? Well, Let's play the risk reward game. At one point, your risk was at a minimum, the low of 16 to the high of 16, and the target is up here. Who wants to risk that much? It's bad risk reward. Target's up here, stops down here. And what traders have to remember is the trader's equation shifts with every change in price. Obviously, that's you got to have some compromise because you're not a computer, and you have to be able to think about things from a logical standpoint and give yourself enough time to think. But at some point, you look at this bar and you say, yeah, this bar is it's about 6 points tall. This range is not huge. 6 points is a lot. In a trading range day, it's forcing me to buy where the bulls got trapped. Maybe I should take profits here. And that's what happens. You get a vacuum up to resistance, and then everybody sells and bears make money. The bears that sold 13 high, the 14 high, or the 15 high scale in higher, and they made money or got out break even here. Now 17, we have an inside bar. It's a pullback. The market went up on 16, pulled back during 17, rallied again on 17. It's an okay swing buy. It's a micro channel since 13. We have 2 legs down and it's a minor wedge bottom, 10, 11, and 12. So probably going to have 2 legs up. And then 18, it's a bear bar closed with a tail below the bar. What about selling below 18? I would not. To me, it's right at the breakout point, the 15 high. It's a tight micro channel since 13. So 1, 2, 3, 4, 5, 6 bar micro channel up to 18. And typically 17 is a high one buy. So traders, whenever you get a high one buy and the context is not great, here the context of this low one short is it's not fantastic, but it's decent. It's not fantastic because bar 5 is a reasonably big bull bar, and the bulls that bought above the 4 high, their entry price was 79 even, and the market went to 85.75. So obviously those bulls made money. Their entry price could have been 79 even. They needed it to go to 79.25. So 425 obviously allowed. So the bulls could have made 5 or 6 points. And if this is going to be a trend day, it should not be easy for traders to make money on stop entries. Here, a lot of overlapping bars, big rally, deep pullback. This tail is a pullback from the rally on 16. So 16 went up, and on the same bar, 16 went down. So it's a rally and then a bear sell-off. And because of that, that increases the risk that there's more sellers above 17, and the bears will at least make money for a scalp. Give me just one moment. Here we go. Now, typically on high one buys typically pull back. They don't necessarily lead to reversals. In other words, bulls buy above 17, they buy more lower. They can typically make money or avoid a loss, which means the bears selling above 17 will typically just break even, or not break even, they'll make a scalp. And that's what happened on 19. Some bulls they buy more below 18. Some get out break even. Some bulls buy with limit orders and scalp out. But the size of 18 is disappointing, and traders will use they'll use the first reversal up to scalp out, and bears will sell. And then 20, we have a big bull breakout. It's a big enough bar, probably going to go a little bit higher, but trading range days are notorious for doing things that look extreme. Breakouts, micro channels, etc., that go further than you think they should go, and then they immediately reverse. So yes, we're in a rally here, but look to the left. What are we what's above, what's next, what's to the left. And we have price action bars to the left that were pretty recent. So bar 6 is the possible top of a channel. We had a bear breakout, a pullback to 6, and then a channel down. Channels evolve into trading ranges. We have a trading range. The bears want to double top 6 and 20 or 21. They want to break below the neckline, measure move down. The bulls, they want to rally, pull back, higher low, major trend reversal. So we have a left shoulder here. We have a head. Maybe we'll get a right shoulder somewhere around here. So if you're buying the 20 close, it's not really ideal. And then 22, the bears that sold the 19 high or the 18 high scaling in higher are making money. And that's what happened on 22. 22, 23, and 24 are disappointing. And typically, whenever you have if you think about it, pullbacks in trends or small pullback trends typically do not have 3-bar pullbacks, 3 or 4-bar pullbacks. They are typically very tight. In other words, you get a 1-bar pullback, you get maybe 2 bars, but the key is the other side doesn't make money. And when you look at something and you see a route, you see a sell-off like that goes below 21 to 24, and you look at that and you say, that's kind of problematic. You know, the bears that sold below a bad bar, 21, put a stop above 21, they made money. And that should not happen in a trading range in a strong trend day. In trends, the reality is you can buy below bars like 20, 21, and use a stop, a measured move down on the bar, and the market will not touch your stop. It might go down to it, but it'll immediately bounce up. And when the market starts to go down, a measured move of the stop entry, that's a warning that the market is in a trading range. Give me just 2 seconds here. I want to make a note of something. While I'm making this note, feel free to comment with some questions because I'm going to go from the first questions asked to the bottom. So whoever asked the questions earlier in the chat, I'll answer first. Okay, there we go. Whenever I see something, so I generally try and make very quick reminders or just snap it onto a PowerPoint slide and make a note. And I challenge everybody to do that. When something catches your eye, make a slide over it because that is how you learn things. Someone asking about the 1 minute chart. I will, if you want to trade a 1 minute chart, prove to yourself that you can be profitable on a 5 minute chart for several months. If you can do that, then maybe consider a 1 minute chart. But let's go back to over here. So too many bars down for this to be a likely bull trend. That means it's probably a leg in a trading range. And legs in trading ranges have very deep pullbacks. Remember, write this down. Trading ranges are forgiving. So bears that sell and scale in, they make money. And what that means is when bears make money below bars and you get pullbacks lasting 3 or 4 bars and the market is not clearly above or below the moving average, that is a problem. And that's a sign of a trading range. Lots of bars down, 1, 2, 3, 4, 5, 6, 7 bars down. It's a 7 bar micro channel. Probably sellers above 26 and at least a second leg down. 27, 28, 29, 3 consecutive bear bars. Is this a sell to close sell off? It technically is, but look where you are. What happened to the bears down here? You had bears that sold, they got trapped, and the market rallied. What do you think the bears are going to do at the same price? They're going to buy. And what are the bulls going to do at that same price? The bulls that bought down here did well. They made a pretty good profit. Well, the bulls are going to buy again. 30, it's a doji. And whenever you get dojis in a sell to close sell off like 28, 29, 30 is that warning that the market's probably not going to go much lower. 31, 32 consecutive bear bars, but you get a sell off to 25 and then a pause on 26, sell off to 29 and then a pause, sell off on 30 and 31. And 32 has a big tail below and it's breaking below obvious support, the 13 low. And because of that, that will increase the risk of the market bouncing. 33, a doji. And typically, remember what I said about micro channels? Whenever you get a 7 bar micro channel, usually there's sellers above. But here, you're getting a 7 bar micro channel at support in a trading range day. In trading range days, when you're in a trend and you get a micro channel, or you get a bear micro channel, and it's not at support and it's in a trend, there's a very high probability that you're going to get another leg down. But when you get a micro channel at support in a trading range day and you've had a very tight channel down lasting 10 or 12 bars, instead of this having a 60% chance of a second leg down and this being a 40% chance of a reversal up, it can be closer to 50-50. It may not be 50-50, but it could easily be 49%. Then 34, bears giving up, bulls buying aggressively. 35, another big bull bar. So we have 34 and 35, two really good looking bull bars. What are the chances that we race above bar 1 and get a measure move of the day's range? It's possible, but the reality is we had strong bull bars up here. We have a tight channel, bears that are trapped. This will lead to a second leg up, most likely. But when you see bars like 34, 35 in a trading range day, it's important to not get too excited. It's okay to buy the close of 34. It's okay to buy the close of 35. But if you're buying the close of 35 and you see that the day's in a trading range day and you're close to the middle, you're in essence you're buying really close to where traders might get trapped. So once the momentum starts to dry up, you'll have more and more traders start to exit. And then 36 is a big bull bar. But if 36 is a small bull bar, 35 was a big bull bar, and now you have a small bar on 36. It closed on its high. That's good for the bulls. But why? If 35 was such a good bar to buy, why is the follow through small? Think about that. If you're buying a bar like 35 and you get a bar on 36 that's fairly small, you couldn't even make a scalp in one bar. Is that what you want to see? Or do you look at that and say, yeah, I don't know, maybe this is still within a trading range day, and maybe I'm about to get trapped into buying too high. And then surprise, surprise, you get an outside down bar. Bears that sold the 35 high, scaled on higher, making money. And then 38's a high one, but high ones high in a trading range. In other words, high ones in trading ranges typically fail and lead to deeper pullbacks. 39 and also 37 was a big bear bar, so it increased the risk of a second leg down. 39 is a bear bar, but it may go lower, but still always in long, probably buyers below in a second leg up from 34, 35, 36. And then 40, we have a bull bar closing on its high. If you're a bear, you definitely get out above 40. If you're a bull, it's probably okay to buy above 40, but you always have to wonder, good signal bar in a tight trading range since 36 or 35. There might be more sellers above 40, and the market could easily get a small second leg down, or it could at least fall below 40 before it reverses up. $41, we have a doji. It triggered the buy on 40, but then it sold off. And then 42, really big bull bar. So we have two legs up, trading range price action, and then a violent bull bar. One thing I want everyone to write down is when you're in a trading range and you see big bars, they look bigger than average. You look at 42, you look at 20, you look at bar 3, you look at bar 16, they're emotional bars. In a trend, so what I want you to write down is trading range days are trading range days have a lot of emotional bars, climactic bars, and they force you to do something emotional. 20 starts to race up, it forces you to buy. 16 starts to race up, you're scared you're going to miss the move, so it forces you to buy. You see 3 start to plummet down, you get scared, so you sell. And the reality is, computers, obviously, they think with logic, they don't think with emotions. The one advantage we have as people is you can use emotions in the right way to do the right thing. If you're confused, it's a trading range. If you look at something and you're like, yeah, I need to sell, this is clearly going lower, it's a trend. But when you see bars like 20 and you look to the left and you've had a lot of trading range price action, be leery because it's probably something that's tricking traders into buying too high. 42 is enough of a surprise, probably going to go a little bit higher. 43, it's a bear bar, but it's not strong enough to reverse 42, probably going higher. I'm going to speed this up a little bit. 46, parabolic wedge, but we're so close to the open of the day, we'll probably have to get there. We may also have to test the high of bar 1. Some bulls bought the close or bought above 1, and the reality is trading range days are very forgiving, so you have to wonder if it's going to let them out. And then we broke above the high of the open. We broke above the open of the day on 49. Best looking bull bar, 2 legs up, spike and channel. So we had a rally to here, pullback, but we clearly went further than that. Maybe it started here. Doesn't really matter. Either way, some bulls buying the close of 47, buying more below 47, scalping out. High one buy on 49, but it's kind of like a triangle, forcing traders to buy at resistance, open of the day, high of bar 1, high of bar 2. So there might be more sellers above. And this is what I've been talking about. Whenever you have a rally that's near resistance and it's lasted for 2 legs and 10 or 15 bars, maybe 20 bars, you have to wonder, especially when the stop's far away, the pullback could be very deep. So when you get a bear bar like 50, in general, it's better to exit and wait for an upside breakout or a deeper pullback. And then 51, another bear bar, and then 52, three consecutive bear bars. And kind of like what I said over here, whenever you're in a rally like 40 to 50, and then you see three consecutive bear bars, and the bears that sold, and there's a good signal bar, and the bears that sold below 50 clearly made money, that will increase the risk that the market is in a trading range and not in a bull trend. Now, a trading range could easily test back up to here. However, it's a strong enough sell-off, expect a second leg down, and the second leg could end below 40. And then we went sideways. Bears basically got two legs up. The bulls got a second entry buy. But the channel down to 52 was tight, so there might be more sellers above 56. And you can see the bulls are failing to make money on stop entries. They're making money below bars, but you have a rally and then a pullback, and traders are deciding, is the sell-off from 50 to 52 a reversal or is it a pullback? 59, a bear bar, and then 60, another bear bar, closing on its low. Consecutive bear bars, probably sell to close and going at least a little bit lower. And then 61, a bull reversal bar, testing the 40 low and reversing up. And this is a great example in a trading range day. When you see a bar like 59 and 60, consecutive bear bars, and it's a second leg down, getting low in the range, traders are wondering if the sell-off to 52 is the start of a reversal. And then they see here 59 and 60, and they think, oh my gosh, I've got to get short. You know, that this is going to crash. It's going to crash down, and the bears are getting a reversal. And that's true. But whenever you get a second leg in a trading range, especially when it's testing support, you always have to wonder if it's going to fail and reverse. And then 61 is a doji, but a big tail below the bar. Probably the first reversal up's going to fail. Sorry about that. Dropped a pin. First reversal up's going to fail. But when you see a rally that goes above 61, like 62, probably buyers below 62 scaling in lower. So for the bears, they should not have allowed this much of a rally, especially the bulls making money above 61. $62 is a low one short, but at support, the 40 low. We could easily fall below 40, and we probably will, but we probably won't fall below 32. Trading range days are notorious for being near. There'll be two support levels pretty close to each other. It'll fall below one, but fail to fall below the other. And then 64. 64 went below 65 went below 40, and then reversing up. So you have two legs down, bear breakout, and then two legs down. And then you get three strong bull bars, and all the traders that bought in here, scaled in lower, made money. 67 is a little bit climactic, but it's three consecutive bull bars. Whenever you have a bear trend or a sell-off, and you get three strong bull bars, and when bulls start making money above bars, they made money above 61. They clearly made money above 65. You're not in a bear trend. You're in a trading range. And trading ranges could test all the way up here or break out to the upside. So bears clearly have to get out. And then 68, you have a doji, deep pullback. Bulls, what do? If you're buying the 68 low, it's not wise to put a stop below 65 because you know there's traders buying below 65. Traders buy below 68. They scale in lower, but they see 69 and they say that shouldn't have happened. We're probably going to go below 65. But if we do, we probably won't go down here, but we could easily fall below this before reversing up. And then you get 69 and 70, testing the 65 low, and then you immediately get this. So you get a micro channel and then a bear micro channel and then a reversal up. But just as the bulls got trapped here, what do you think is going to happen up here? Traders are going to get trapped. So the bulls that bought here, disappointed, 69.70, getting out here. That's a very common thing. Bears sold this breakout. They sold the high of 71. They scaled in higher. Guess what's going to probably happen to them? They got out. And that's what creates tight trading ranges. Traders sell on the way up. They make money. They buy on the way down, scaling in lower. They make money. And they do that back and forth. And we pretty much went sideways into the close. So for stop entries, might be okay to sell the close at 2, betting on a second leg down. Some traders sell below 3. I thought the best stop entry was probably selling below 6 or buying above 13. But 13 is kind of a Walmart trade, tight bear channel. So we could easily go sideways for 3 or 4 bars before we rally. But some bulls, okay to buy above. Okay to buy above this bar, betting on 2 legs up. And I thought buying above 40 is reasonable, selling below 50, buying above 65, but hard to do in a tight bear channel. And that's probably it for stop entries. For limit orders, sellers above 4, scaling in higher, but hard to do when you see 5. You've got to be really prepared to scale in, and that's pretty challenging. Sellers above 7, betting on a second leg down. Buyers below 10, buyers below 11, even buyers below 14 or 15. Buyers below 18, sellers really up here, but hard to sell when you see 20. And then sellers above any bar here. So sellers above 26, probably buyers below 13 or below the 30 low, 31 low. Probably a leg down in the trading range, which means we're going to bounce. Buyers below 36, below 37, below 38, betting on a second leg up from 34 to 36. There's a second leg up. Sellers above 53, 54 for a second leg down after 50 to 52. Buyers below 62, 63, betting on the bottom of the range after 2 or 3 legs down. And obviously I talked about this, bears selling above bar, scaling in, bulls buying below things. Now the issue with buying 68 is you have obvious breakout points below. In trading range days are really, really common to test the breakout point, close it, and then reverse up. So a lot of traders, they take what you can call a reach trade. If you were in the Orlando event with Al and Ali Offshari, you heard them mention reach trades. Instead of buying the 68 low, they'll buy 5 or 6 points below 68. So in other words, they look at this low, they buy somewhere down here, maybe the 67 low, betting that we'll sell off further than what bulls want, but we won't collapse, and then we'll go back up. Buy the close, sell the close of 3, scaling in higher. What about buy the close, sell the close 20? 20 might be more of a sell the close bar. 3 legs up, top of a trading range, first break above the moving average in a lot of bars. Sell the close 24, 25, 26, probably buy the close 35, scaling in lower. Sell the close, probably you can buy the close 42, buy the close 44. 47, it's probably more of a sell the close bar. It's 3 pushes up, 1, 2, 3 at resistance, but hard to do. Selling the close at 52, probably okay, but you're selling at the moving average, so not ideal. Sell the close 60 for a small second leg down, but when you see 61 and then 62 go up as high as it did, allowing the bulls to make money in here, a lot of traders scalp out, and then you can buy the close of 57, but difficult to manage. Tight bear channel, you're buying after 3 bull bars. Most traders are not capable of buying the close and scalping out or buying and scaling in lower. So if you buy and then you see a bar like 67 or 69, most traders should just go flat. Let me take a look at some questions. And the reason if today was stressful, traders should trade smaller. That's why I recommend so much trading the SPY. Trade something where you just don't have to worry. Okay, question. At what point do you go from possible trend to concluding a trading range? Yeah, when I look at this day, trading range days, when you get the way you look at it, so what they're asking me is when do you conclude that a trend is now a trading range? And you start with breakouts. You have a strong breakout, follow it through. Odds are you're going to get a second leg down. But then you look at this rally and you say, that's pretty disappointing. That's pretty deep. The bears are still probably going to get a second leg down. But when you see a bar like that, it increases the chances that this might be more of a leg in a trading range. And there's other nuances. Bar one is a bull bar. We gap down. The past 2 or 3 days have had a lot of selling pressure, so you know the day is going to have more sideways trading today. But for me, if I'm just looking at this, I know the odds are it's going to get a second leg down. And then I see this big tail on 10, big tail on 11, big bar on 12. And this is it right here. The market sells off, starts to enter a trading range, and then it starts to go down. Channels are notorious. You've heard Al mention this in the trading course. Channels are notorious for as soon as you think it's become always in short again, so it gets neutral here, and then it sells off, and you say, yeah, we're breaking out to the downside. We're going to go lower. Well, you're in a channel, and when it's clearly selling off in a channel, better way to say that is when it looks like it's always in short in a fairly weak channel with a lot of tails, when you get the big bar, usually it pulls back, and that's what it started to do here. Then you start to get these bull bars and you think, yeah, it's always in long, and then it starts to pull back. So I'll spend more time. I unfortunately don't have time to really explain that at this moment, but I do want to make more videos on that discussing transitions. The key with today, though, is to really think about how frequent the market reverses back and forth. When one thing that looks good for one side, it fails and immediately reverses. It's buying above 4 a high probability scalp. There's logic to it. I wouldn't do it. And the logic is because of bar one, there's trapped bulls. Bulls buy, scale in. So you know there's going to be a little bit of a bounce. But the problem with 4 is if you buy above it, where do you put your stop? So if you're buying, I think unfortunately you have to buy more. And most traders, when they see 1 and 2, they should look to sell for a second leg down. Okay, what did traders think on bar 10? Yeah, to me, bar 10 was a sign that bulls were buying and making money. But it was big enough bar, I thought it would get a second leg down. So traders are selling on the way down. The bar, whenever you get bars, trading range days have bars that become extreme and then reverse intra bar. You get a big bear bar, and then because it goes down quickly, you sell the 3 close. You're disappointed here, and then you get this big sell off quickly, and you think, oh, I'm going to take my profits. I don't want to be disappointed again. But this bar went down far enough that a lot of traders sold on the way down, scaled in, and then we got a second leg down. Okay, I unfortunately have to make this video shorter than usual, but just make a note. I am planning on Saturday. It might be, I don't know when, either Friday or Saturday in the US time, obviously. So some point on Saturday, I'm planning on doing a Q&A on the trading course on this YouTube channel, but I'll make the live stream. I'll schedule it in advance, and then for those in the Discord, I'll put it there as well. So ideally, go to the Brooks Trading Course website, find how to enter on the Discord. You'll see it, or just pay attention to this YouTube channel and you'll see it posted or scheduled. Okay. Thank you guys for watching. And there is no live stream on YouTube tomorrow. It'll be in the trading room. So for those of you subscribed in the trading room, you can see it there. But the Q&A over the weekend will be hosted on this YouTube channel. All right. Thanks everyone for watching, and I will talk to everybody soon. And by the way, the asking the questions is helpful and relevant because it's giving me ideas of what the most questions are, what the most relevant or frequent questions are, because I do want to make more videos discussing some of these topics. So by getting a list of questions, it's helping me better understand what people would like talked about more. Okay. Hope everyone has a good rest of their day. It's actually not a bad idea. Someone asked if I can drop the link on Discord. Let me try that really quick. Even though I already did the, let's pretend like. So give me 1 second. I'm going to see if I can add it. It is not letting me, but if you go to the brookstradingcourse.com, there is a link there. So, okay. Hope everyone has a good rest of their day.